Good afternoon, everyone, and welcome to our Vincent's Case Collective series. Today I'm joined by Mischa Bolot, who's our Wealth Protection Advisor at Morgan's North Key. And today we're just going to do a bit of an update in the wealth protection space. That's just a general disclaimer to say it's general information only, and it doesn't take into consideration your personal circumstances. So please, if you're looking to take any actions as a result of this presentation, get in contact with Mischa and she'll be happy to discuss your position. There's Mischa. Okay, so today just 4 sections, so it's about a half an hour. So what we want to do is do a bit of an insurance market update, and there's some pending changes there, Mischa. A lot happening in our market, so it's good to keep abreast of these things. A question that we always get is how much is enough? So when people look at their own insurance, Mischa's just going to talk about just the key things to consider when determining, because everyone's different, and so what are the things we need to go through in order to assess how much we actually need. So Mischa will cover that off. Importantly, navigating health and insurance. So a lot of health issues around. We might even touch on COVID and how mental health might impact applying for insurance, but just what to expect through that process and how to go through that process, and what to look out for and be mindful of when going through underwriting. And finally, we all hold a lot of insurance through super. So Mischa just wants to cover off on a couple of things around the things that you should know about your insurance through your superannuation.
Yep.
All right, with that, Mischa, we'll just kick this off.
Perfect. So as Mark mentioned before, there has been a lot happening in the insurance industry at the moment. So what I'd like to do is just cover off some of the key changes that I think are most important to be taken into consideration. So one of the first changes that took effect on the 1st of April this year was that agreed contracts are no longer available on the market for income protection. Now, there is also a second phase of changes that are going to be released on the 1st of July 2021. Now, these changes haven't actually been set in stone as yet, but some of the changes that APRA is considering at this stage are that they want to be able to the insurance company is to reassess your occupation and income every 5 years. And then they're also looking to introduce a second tier of disability criteria for long-term income protection changes. Now, I did actually do a detailed update around the income protection changes that are going to be introduced. So if you would like to find out more about those and how they could potentially impact you, I've attached a link there for your reference for you to find out about what these mean and how they're going to potentially look next year. Now, another common thing that I've been seeing this year is a lot of out-of-cycle rate increases. So what is an out-of-cycle rate increase? So what can happen is if an insurance company has potentially outlaid a significant amount of claims this year, for example, what they try to do is increase their costs or increase their premiums to try and recoup some of their costs. So the out-of-cycle rate increases that I've seen this year have ranged from anywhere from 5% up to 40%, which is a huge increase. Now, I get asked a fair bit, well, why does the insurance company look to apply these out-of-cycle rate increases? So the reason why is, one, they may have had a significant amount of claims that year. Another common one is if the interest rates are decreasing, what happens is the insurance premiums tend to increase. And the reason for that is the insurance company isn't essentially getting as greater returns for their funds as what they normally could be. Okay. Another thing that I've seen is the length of claims has also increased over the last 5 years by 38%, which is quite a significant increase. So again, the out-of-cycle rate increases are a way for the insurance company to try and recoup costs. But just because they're doing that doesn't mean we need to sit back and take that either. So it's really important that you conduct annual reviews of your insurance to keep an eye on how much you're actually outlaying on premiums. Another really important topic that I covered was COVID support. So a lot of people have been impacted quite significantly by COVID. I did run a session on ways that may be able to provide financial assistance around your insurance premiums. One example of that is if you're currently paying for premiums out of your pocket and you have lost a job, for example, some insurance companies would look to potentially waive your premium for 3 months and you'd still be covered during that period. If you are experiencing any type of financial hardship due to COVID and you would like some financial support around your insurance premiums, I have added a link to that session that will be able to provide some hints and tips that you might find useful, or feel free to reach out to discuss further.
All right. So, Mischa, with that there's a couple of things that, that seems to be a bit of a theme there. One is that length of claims have increased. So that increase of the length of claim of 38% just means people are on support for longer.
Longer, that's correct.
So that coupled with, so you would appear that the claims is an issue for the insurance companies.
Mm-hmm.
The returns are an issue for the insurance companies. So we're seeing higher premiums.
Yep.
And is that also the driver for these agreed contracts on income protection? Is it trying to get control of what that market looks like at the moment?
Yeah, exactly. Just trying to recoup the costs and the bottom line and how much they're actually outlaying. So, as I said before, now it's more important than ever that you be reviewing your cover to make sure that, one, you're adequately protected.
Yep.
Two, if you don't have income protection yet and you need it, I suggest you get it in place ASAP before the new changes come in from the 1st of July 2021, because the terms of the new contracts are not going to be as favourable as what we are offering now, or the insurance companies offering now. And as I said before, we never want to pay more than what we need to at the end of the day for insurance. We want to make sure that we're protected, but we also don't want to be paying unnecessary premiums when we could be putting that towards debt reduction and our children and wealth creation.
Absolutely.
So a lot of people tend to set and forget insurance, and then their premiums blow out quite significantly. So make sure that you are reviewing on an annual basis to keep those premiums under control.
Perfect. So get your insurance reviewed, and if you don't have it, get it in place before these
changes come into place.
Excellent.
Yes,
especially with COVID, expecting a lot more mental health claims as well. So you need to get your position sorted. So how much is enough?
Yeah, so this is a really interesting topic, and it's not one size fits all. Everyone's different. Everyone's at different life stages. So again, it's a bit of a bell curve. When I look at my position, I've got 2 kids, I'm married, I've got debt, so I'm going to need a lot more cover now. But as my children leave the home and my debts decrease, ideally I should be tapering back my cover to help offset any increases in price.
Yep.
So what I thought I'd do today is just run through some hints and tips of the different types of cover and what people look to take into consideration for sums insured. Okay. So the 4 different types of insurance available on the market are life, TPD, income protection, and trauma. So life insurance is in the event that you pass away, you'll receive a lump sum. TPD is your total and permanent disablement. So if you're unable to work ever again due to an injury or illness, you'd receive a lump sum. Income protection covers 75% of your income on a monthly basis due to an injury or illness, and this could be minor or major. And then lastly, there's trauma insurance. So trauma insurance covers big ticket items. So cancer, heart attack, stroke, major head traumas, any type of medical trauma. You'd receive a tax-free lump sum. And that can be for minor medical traumas too. For example, if hypothetically you had a stage 1 melanoma and it was cut out and you were fine and you went back to work, they would still actually, some insurance companies will still do partial payments for those types of medical traumas. Now, a lot of people ask me, well, wouldn't TPD pay out in the event of a medical trauma? Well, yes and no. So you could be diagnosed with cancer tomorrow, but not be deemed totally and permanently disabled by that. And you may spend the next 6 months going through treatment. So it's really important that we sort of look at all areas. Now, let's just say you did have a medical trauma and you were deemed TPD. Well, then you get both paid out at the same time. And not to mention your income protection is also going to kick in. So,
but they have even if they are getting paid out, they have different purposes.
Exactly.
Trauma to cover your medical.
Correct.
TPD to cover your alterations, and income protection to carry you through to accessing super.
Exactly. Yep. So let's walk through that. Good transition there, Mark. So let's walk through, I suppose, the different types of cover and the types of things that people would normally look to take into consideration. So let's just say you've got a family, Mark, and you had to think about what would happen in the event one of you was to pass away. So if we looked at the husband, for example, you've got your home loan there or debts, any debts that you've got. So your main thing, first and foremost, is you want to clear any debt so you're not leaving that towards for your family to look after, okay? The second component is to look at any funeral expenses, so usually around $20,000 for funeral expenses. Then you've got to take into consideration child expenses. So that's schooling. If you had young children and you needed to look at potentially getting a nanny in the home or daycare fees. So depending on how much support you're wanting to provide your children, that could range anywhere from $10,000 per child till they reach age 21, or up to $30,000 per child until they reach age 21. So we would project that out and make sure that your children were well and truly taken care of in the event that you were to pass away. And the other component is income replacement. So let's just say you had a couple and one of the partners was the primary income earner, and then you had another person that was staying home and caring for the children. And if the primary income earner passed away, well, yeah, it's great to clear the debt, cover medical costs. Clear the debt and cover child expenses, but then how are they going to survive?
Cost of living.
Correct. So what we would need to do is make sure that there was enough income coming in to ensure that the family was sustainable throughout the rest of their for the rest of their life, essentially.
So that would include a lump sum that is available for investment, and then the return on that money, as well as potentially capital, depending on their wishes, is to replace that cost of living funding.
Exactly.
Yep.
Now, look, and not everyone looks to do income replacement. Some people say, oh, they'd be comfortable just clearing the debt and child expenses. Well, but again, that comes down to what you personally like to see happen in the event one of you was to pass away.
Yeah, and the income replacement, I mean, you are covering some of the expenses, and some of your expenses do disappear with debt, mortgage repayments.
Yep.
But so it just comes back to what their lifestyle is and what they want to maintain within that lifestyle.
Yeah. So the next cover is TPD cover. So this is if you're unable to work ever again. So the main things there, again, which we said with life insurance, is we want to be able to clear any debt that you've got, so you don't have to worry about that. Medical and lifestyle alteration expenses. So a lot of people think, oh, well, private healthcare is going to cover me. Well, no, it doesn't necessarily do that. So let's just say you had to fit out the home, get a new car, and adjust your lifestyle due to the disability that you have suffered from. So we need to make sure that any sort of medical lifestyle alteration expenses are covered. Again, child expenses, so we want to make sure that your children will be completely taken care of. And then income replacement. So with TPD, your income protection is going to kick in. Okay, so that's 75% of your income. So normally you've got a different waiting period and benefit period. So with income protection, normally you can have a 30-day wait. So what that means is if you're unable to work due to an injury or illness, after 30 days, it's going to start paying you your monthly sum insured. Now, if you're unable to work ever again, normally the most common benefit period is age 65. So it's going to cover your monthly benefit, pay that to you till age 65. Okay, so you're going to get that in the event of your TPD. Now, a lot of people say, oh, well, I would like to get 100% of my income until age 65. So what you could do essentially is fill that 25% shortfall within your TPD.
Yeah, so lump sum.
Yeah, but again, it's up to you as to whether or not you want to go to that extent, or if you're just comfortable with the 75% of your income, you no longer got debt, and then all your child expenses and lifestyle sort of alteration expenses are also covered. Okay.
And that the income protection, that component that you receive is an assessable amount in your tax return.
It's taxed at your marginal tax rate. And then, look, I won't touch too much on the income protection. I think I've covered that there. But again, you could get income protection for a minor injury. Let's just say you're off work for 3 months due to a certain injury. You wait your waiting period. It pays you out. If you can return to work, then it'll stop paying you. If something else happens, then you wait your waiting period and you can go to claim on it again. Okay.
Are some of those proposed changes to wind back the period that you can have income protection for until age 65?
So how income protection works at the moment is it's a one-tier definition. So if you're unable to work due to an injury or illness, as long as you've got someone signing off saying you're unable to work, a doctor, then you're going to be able to stay on claim. And you could potentially stay on claim all the way up to age 65.
Yep.
What they're saying now is they're trying to put in a second-tier definition, which is once you've been on claim for a certain period, then you're going to have to meet a total and permanent disability to be able to stay on claim. Yep. So whereas right now you could quite easily stay on claim for a far minor injury or illness, and you don't need to have a medical practitioner sign off to say that you're unable to work ever again.
So with a total permanent disablement, or the TPD,
yep.
2 doctor certificates is normal,
2 medical
practitioners
to sign off.
Yeah.
And then lastly, we've got the trauma insurance there. So some people, look, in trauma, not everyone wants to clear all of their debt, but they may decide they just want to clear a portion of their debt, for example, $100,000 of their debt. We also want to cover a portion of your medical lifestyle alteration expenses. So medical costs for cancer can go up to $50,000. Some people may want to cover that for $100,000. Also, you may want to factor in the child expenses or income replacement again. But these are sort of the main things that we look at when doing an insurance analysis. We work through with our clients to see, okay, well, in the event something did happen, what's important to you, and how much do you want to have? And that also comes down to cost as well, Mark, because even though you may want X amount of cover, you've got to balance that with also how much you're willing to outlay on premiums.
Yeah, and I think if you look through this, and the reason why it's always it depends, is because of your cash flow, like you just said. How much can you afford to cover your insurance premiums? So you may not get your optimal, you may get what you can afford.
Yep.
And secondly, everyone's position on debt, children's desired lifestyle, existing financial position, income levels, they're all different.
Yeah.
So really, it's a personal analysis is what's required to get your optimal position.
And if you haven't done an analysis and you require one, I definitely recommend reaching out and going through the exercise. And coming back to what I initially said before, those annual reviews are so important that you look at doing the analysis each year and then tapering, either increasing or decreasing depending on your personal circumstances.
Yep. Okay, so that's all the different types of insurance. So the next part is actually underwriting, apply for the application.
Perfect. So, look, one of the most challenging things I see in the industry these days is underwriting. So what is underwriting, Mark? So when you apply for insurance, you have to go through a detailed application around your health with the insurance company, okay? And off the back of that, depending on what you're applying for or your health, they may ask you to go complete range of medical tests, so blood tests, quick checks, so height, weight, blood pressure, so forth. And off the back of completing your application, there's a couple of outcomes that can happen. So firstly, the insurance company can approve your cover at standard rates. So what that means is they'll cover you for what you've applied for, okay? Secondly, they could put a loading on your cover. Examples of loading are also, and what I mean by loading is they could double or triple the cost of your premiums and make it more expensive. Examples of a loading are if you smoked, your BMI wasn't within normal limits, or you had a certain pre-existing medical condition. The other, another component that they could offer is an exclusion. So what they could say is anything directly or indirectly related to a specific pre-existing medical condition, they will not pay, but for everything else they will. And then lastly, a decline, which is not ideal. So the most important thing to do before you go down the world of insurance is to always complete a pre-assessment with your advisor. So what a pre-assessment is completing a detailed questionnaire around your health, but it's not actually formally lodging it to the insurance company, because once you lodge it, then that's going to impact you down the track. And then what we can do with a pre-assessment is we can actually send your pre-assessment to every insurance company on the market and go, what potential terms would you offer my client?
Without their personal details?
Yes, without their personal details. And none of this is actually kept on record. So it's just getting a gauge of what the insurance companies would potentially offer. Now, mental health and musculoskeletal conditions are probably the most common pre-existing conditions or exclusions that I've been seeing on the market. The highest claims now are all mental health related. And I suppose we're going to see this increase rapidly now with COVID, and obviously all the people sort of been impacted by COVID-19. So when it comes to mental health, what I've been seeing with the insurance companies on the market is they're not really going to take any risk around mental health anymore, due to the fact that it is probably their biggest payout in relation to claims. So what does that mean for clients, which is quite scary, because you may have a client that has anxiety and depression, is completely stable, aren't having any symptoms, but they are on medication, and they're completely fine and they're functioning. As long as they stay on their medication, they're okay. Insurance companies are coming back now and saying, regardless of whether you're stable or not, if you're on treatment, including medication or counselling, they're going to exclude it straight away. So we want to be able to get the best possible outcome in relation to terms, because if hypothetically you had an exclusion placed on you, well, then a risk of not having that paid out in the event of claim. So we really need to look at what alternate options are available, or how can we get you cover without having exclusions. Now, with mental health, if you have, because a lot of people may potentially have exclusions on their cover now for it, if you have been symptom or treatment free for a period of time, they may potentially look to review your exclusion. So just because they initially place it on there doesn't mean it's sort of stuck there for life. So I always say revise that. If your health changes, make sure you revise the terms that you've been offered by the insurance company to see if you can potentially have them removed.
Yep.
Because I have.
So that potentially could remove some of that loading.
Yeah, or exclusion,
or
depending
actually
on.
give you cover that you don't have.
Yeah, and if you did have a pre-existing medical condition that wasn't mental health related, I always say revise it. I do see a lot of advisors in the market, they only pre-assess with certain companies, whereas, and I would double check that. So I would be asking, well, who are you pre-assessing with, or who was that initially put through? Because every insurance company underwrites differently. And I have had clients where I've pre-assessed with all the insurance companies, and there's only been one company out of the however many that I've contacted that was going to actually offer my client cover.
Yep.
So if you have terms or you have pre-existing medical conditions and you want to revise that, pre-assessing is the best option, and to go to everybody to see what potential terms that they would look to offer.
Yeah, I guess that's the benefit of yourself being a broker, is that you can offer that around as opposed to just going to an insurance provider directly.
Yeah, exactly. And we shouldn't be limiting, like when it comes to terms, we shouldn't be limiting to one insurance company. We should be going to them all to go, well, who is actually going to offer us the best sort of outcome at the end of the day.
Now, I guess there's a couple of things that stick to mind when listening to you speak there, Mischa. Is one is probably get in and get your insurance cover early, because
when you're fit, young, and healthy,
when you don't have those pre-existing conditions.
Yeah.
And two is, and I know it happened to myself when you're getting cover for me, is that disguise everything, because even if you think that something's not important, it's all about disclosure, because if it's not important, they'll discard it. But if it is important, that even when you're not aware of it, then, it has the potential to, one, it'll come up, because, during that underwriting process, they do request medical records, or potentially medical records. And two, you could be faced with a decline as well. So be upfront in that pre-assessment.
Or a non-disclosure. So what Mark is saying about the non-disclosure. So when you complete an insurance application, you are bound by duty disclosure. So it's important that you disclose everything to the insurance company. If you are deemed to have a non-disclosure, well, they don't essentially need to pay you out in the event of claim. So it's better to disclose everything up front, even at pre-assessment stage, so that we can cover that all off and make sure that we're getting you the best possible outcome. And the last thing that you want is, if you didn't disclose something and then you went to go claim and they said, oh, well, back on your medical records, we could see that this was a condition or something that had impacted you. So
yep. Okay, so structure-wise, if we move forward to the next slide, income protection, you tend to hold that in your own name, because you get you can have some super, but tend to be in your own name, because you get a deduction at your marginal rate for the premiums. Mm-hmm. Trauma outside as well, and death and TPD, it could be both. So one of those is superannuation, because from a structure point of view, people either tend to have insurance inside super because it's the default with their employer. Mm-hmm. As well as some other reasons. I went too far, did I?
No, that's right. Yeah, let's transition.
So maybe so I shouldn't have a license for this. So maybe if you could just run through the important things to know about, the different types of policies, and what you should own in super, outside super, and what we should be aware of.
So This next slide that I'm going to be talking about is the different types of insurance available on the market. The most common ones are group insurance that you hold through your superannuation fund, or retail insurance where you go to a company. Usually you obtain retail insurance via a financial planner, and you go through a detailed application around your health. They provide advice around that, which I normally implement on your behalf. And this is going to be a great segue as well around if you've got pre-existing medical conditions and how can you get cover without potentially having exclusions or loadings applied to your insurance. So what I wanted to walk through now is the difference between group insurance, so the stuff that you've got via your industry fund or whatever superannuation fund you hold, and then the retail insurance, because there is a big difference between the two.
Yep.
Now, what commonly happens is most clients say, oh, I've got insurance inside of my super. Now, this is the insurance they've been given by their superannuation company, and they didn't necessarily go through underwriting to obtain the insurance. It was just given to them, okay? Versus the retail insurance where you're always required to go through underwriting upfront to obtain the cover. Now, there's different features and benefits that can be applied to insurance. So if we look at the slide here today, so there's two ways, first and foremost, that we structure insurance. So inside a super where the premium gets deducted out of your super fund, outside a super where the premium gets deducted out of your bank account or credit card. Now, the different types of insurance we can put inside a super are life, TPD, income protection. The only one by law that cannot go inside of super is trauma. That has to go outside. And the other policies there, life, TPD, income protection, can also go outside. Now, the only tax effective policy which Mark said before, having it structured outside of super, is income protection. You can claim 100% tax deduction on that. Most people opt for the superannuation environment because of cash flow. Most people are focused on debt reduction and wealth creation, and it doesn't impact their cash flow. It's also actually tends to be a little bit cheaper coming out of superannuation due to the tax environment, the 15% rebate that you'd receive. But everything we do in life has pros and cons, which I'll talk about now. So if you structure your insurance outside of super and you were to go claim on your insurance, and your insurance claim was approved, well, the money is paid directly to you, okay? If your insurance is structured inside a super and your claim's approved, the money is paid to your superannuation fund. Once the funds hit your account, then you've got to apply separately to meet the government's condition of release to be able to access the money. Now, on the 1st of July 2014, the government changed the condition of release and how we access funds in the event of insurance claim. It's tightened up quite significantly, so there's a risk that we've been paid, but then you can't get it out. So a perfect example for this is income protection. So let's just say you had a minor injury or illness. Well, the superannuation condition of release, you need to have the 2 medical practitioners to sign off to say that you're unable to work ever again. Well, are you going to be able to necessarily meet that if your injury is minor? So there are cases where people are having their money paid to their super account, but then they can't actually access it because they're not meeting the required definition to be able to get their money out.
So income protection it's to cover your wages when if you're on an extended period.
Yep.
But it doesn't necessarily mean forever.
No, it can be short term, long term, depending on the extent.
Whereas a condition of release in super is that you're unable to work forever.
Exactly. So since these changes have happened, insurance companies have created certain benefits to help us get around this, which I'll cover off in a second. So if we look at life and TPD, so normally life and TPD are structured inside a super, and you'll have some default life and TPD sitting in your super fund. So these two policies are linked together. So what I mean by that is if you had a successful TPD claim, then it automatically cancels your life insurance, okay? Which is terrible. We've been paying for both. If you've got family, you're going to want to make sure that they get the life insurance as well. So what we need is what's called a life buyback. So what a buyback means is if you claim on your TPD, you can still claim on your life insurance. So in relation to retail cover versus group cover, so no group policy actually offers a buyback at all with their insurance, with their life and TPD, versus the retail insurance, they're always going to offer that buyback for you, okay? Now, with TPD, there's 2 types of occupations. So there's more than 2 types, but the main ones we're going to discuss today are any and own occupation. So any occupation means if you can go back to any job, worked in, trained in, educated in, versus own occupation, which is what you specifically do right now. So own occupation is a far more comprehensive cover. Now, we used to be able to structure own occupation inside a super. We can't anymore. It has to be structured outside. But also having TBD own occupation outside of super is not the most tax effective way or cash flow effective way of structuring your cover. So what insurance companies now is created a split benefit. So how this essentially works is, let's just say you had $500,000 worth of TBD cover and you needed to claim. What the split benefit's going to do is, firstly, they're going to go and assess you under the TBD any occupation definition. If you did not meet the any occupation definition or the conditional release to get the money out, then they're going to go and assess you under the TBD own occupation outside of super. How the premium structure works for this split benefit is 2/3 of the premium gets deducted from super and 1/3 of the premium gets deducted out of pocket. So essentially, Mark, it's giving us best of both definitions, minimizing the impact on our cash flow as much as possible, and also providing us peace of mind that we're going to be able to get the money out. So this split benefit can be applied not only to the TBD, but also to the income protection as well, which is really important. So coming back to retail versus group cover, so no group policy actually offers this split benefit. You're just going to get the TPD any occupation inside a super as standard, and then the income protection is always going to be inside a super. So there's a risk with the income protection that if you don't meet the condition of release, you may not be able to get the money out. That's why I say with income protection especially, it's so important to have that split benefit applied or have the policy structured 100% outside of super. Okay.
So I think the message there is that cover's just not cover. It's not apples and apples. So no. There's a difference in the quality of the contract with your superannuation cover. And you also need to understand what that looks like, because based on your circumstances, you may require life buyback and you know, how do you access monies at your time of need? Exactly.
And there is a particular group super policy out there where if you had a successful TPD claim, not only is it going to cancel your life insurance, but they're also going to cancel your income protection at the same time, which is, that could be so detrimental in the event something happened to you. So what I say is, if you do have group cover, it's definitely worthwhile reviewing it to see what you've got versus what's available in relation to retail insurance.
So group cover, just a summary of that, is typically employer cover, so corporate super?
Yeah, so industry
super?
Yeah, yep. Corporate super, industry super, personal super, any type of insurance that's held inside of your super arrangement would be worthwhile reviewing. Now, group cover, the quality may not necessarily be there, but then if you had potentially a pre-existing medical condition
and I couldn't get cover,
and you couldn't get cover, or you could get cover but they were going to apply loadings or exclusions to your insurance, then group cover may be a really great way for you to get cover where you may not necessarily have been able to before. So as I mentioned previously, with group insurance, you're not always necessarily going through underwriting when they give it to you. Now, just because you're not going through underwriting doesn't necessarily mean that there's not terms and conditions within your own contract. So within this type of arrangement, sometimes within these products, they have pre-existing clauses within the PDS. So what they say is, for the first 2 years or for the first 5 years, we're not necessarily going to cover pre-existing. But if you've still got it after that, then we will potentially cover your pre-existing medical conditions. There are some companies where they say they may potentially never pay pre-existing medical conditions, but it's really important that we look at the terms and conditions of your group insurance to see what they're offering in relation to pre-existing condition clauses. So there is one particular company in the market, Mark, which is a great industry fund, and their particular arrangement is, if you are working, you've got an employer contribution going into your super fund, they'll actually offer you $600,000 life TPD and cover your income protection for 2 years. For the first 2 years of holding this insurance, they're not going to cover pre-existing, but after 2 years, they are going to cover pre-existing. So again, if you do have a pre-existing condition, these types of terms are amazing because we want to be able to get cover without terms being applied. So there are options. So what I say is, again, touch base, let's review it and see where you stand, what terms would be potentially applied, and if they are, then we can look at the group super option to see if there's alternate ways we can get cover without having those sort of put in there for the long term.
Excellent. All right. We've got we're a bit out of time at the moment, so we won't go through these questions. But you feel free to contact Mischa directly.
Yep.
So thanks very much, Mischa, for your time today.
Thanks for having me.
Obviously, a wealth of technical knowledge around insurance and how to get cover and the appropriate structures of that cover. So please, one thing that is evident, based on today's discussion, is that insurance is not typically what people think. It's a set and forget. You do have, changing market conditions. You do have out-of-cycle increases, which you can, look at your options, whether it's pushing back or actually looking at alternatives. And you do have changing circumstances. So, annual reviews on those sort of things are critical. Yep. All right. So unfortunately, that's all we've got time for today. Thanks very much for joining us, and look forward to speaking to you guys, not with you, to you guys on the next series. Thank you.
Take care.